The U.S. stock market is currently closed. At the closing bell on Friday, September 5, 2025, shares of Incannex Healthcare Inc., trading under the ticker symbol IXHL, ended the session at a price of 0.525. This represented a significant intraday decline of 9.48%, a move that wiped a considerable portion of its recent gains and left many investors questioning the near-term trajectory of this highly speculative biotech. The session was marked by heavy trading volume, with over 51 million shares changing hands, far exceeding its typical daily average. This surge in activity on a down day points to a fierce battle between buyers and sellers, and it immediately shatters the simple expectation that positive clinical news automatically translates to a sustained upward march in share price. The reality is far more complex and turbulent, revealing a landscape where promising science collides with the harsh mechanics of market sentiment, capital flows, and the ever-present risk inherent in the pharmaceutical development sector. Many who follow Incannex hold a powerful and alluring expectation that this small-cap company, with its innovative pipeline of cannabinoid and psychedelic-based therapies, is on the verge of disrupting massive healthcare markets. From obstructive sleep apnea to traumatic brain injury, the narrative is compelling a forward-thinking biotech taking on conditions that have long eluded effective treatment. This belief was significantly bolstered by a series of positive announcements in recent months, including encouraging top-line results from its Phase 2 trial for IHL-42X, its lead drug candidate for treating obstructive sleep apnea. The market initially reacted with euphoric buying, sending the stock soaring from its lows. The expectation was that this was the beginning of a steady upward re-rating as the company moved closer to commercialization. However, the reality presented by the recent trading sessions is one of extreme volatility and a clear divergence of opinion among market participants. The sharp sell-off suggests that while the long-term potential may be intact, the short-term path is fraught with uncertainty and profit-taking pressure. This isn't a simple story of a miracle drug in the making. It's a high-stakes drama where every piece of data is scrutinized and every market tremor can trigger an avalanche. Diving deeper into the recent price action, the stock has been on a roller coaster ride. After hitting a 52-week low of just 0.08, the positive clinical data provided the catalyst for a spectacular, multi-100% rally. This is the kind of explosive move that attracts traders looking for quick profits. The expectation for many of these new entrants was likely a continuation of this parabolic trend. The reality, however, is that such rapid ascents are often unsustainable. The recent pullback, including Friday's sharp drop, can be seen as a consolidation phase, or perhaps more pessimistically, as a sign that the initial excitement is beginning to wane, giving way to a more sober assessment of the risks and timelines involved. The high volume indicates that many early investors and traders who bought in at lower levels are now taking profits, creating significant overhead supply that new buyers must absorb. This selling pressure is a tangible force that the simple narrative of good news equals higher stock price often overlooks. Furthermore, the company's announcement of a share repurchase program in late August, while theoretically a sign of management's confidence in the stock's undervaluation, has not been enough to stem the tide of this recent selling, suggesting that broader market forces and sentiment are currently the dominant drivers. To understand the stakes, we must look at what Incannex Healthcare actually does. This isn't a traditional pharmaceutical company. It operates on the cutting edge of medical science, developing medicinal cannabis-based products and psychedelic medicine therapies. Their goal is to tackle conditions with significant unmet medical needs. The crown jewel of their pipeline is IHL-42X for obstructive sleep apnea, OSA. A massive market affecting millions globally with limited effective treatment options beyond cumbersome CPAP machines. Positive Phase 2 results are a critical milestone, demonstrating proof of concept and de-risking the asset to a degree. The expectation is that this success will pave the way for a successful Phase 3 trial and eventual FDA approval, unlocking a multi-billion-dollar revenue stream. The reality is that the journey from Phase 2 to commercial approval is long, expensive, and filled with potential pitfalls. Clinical trials can fail, regulatory bodies can demand more data, and competitors can emerge. Investors are now weighing the promise of the Phase 2 data against the significant execution risk that still lies ahead. The company's other programs, targeting conditions like traumatic brain injury, concussion, and rheumatoid arthritis, add depth to the pipeline but are in earlier stages of development, meaning their potential contribution to the company's valuation is heavily discounted and further in the future. The macroeconomic environment adds another layer of complexity that challenges the simplistic company-specific expectations. We are in a market that has become increasingly risk-averse. Capital is more expensive, and investors are less willing to fund speculative, pre-revenue biotech companies without a clear and relatively short path to profitability. While Incannex has reported holding a reasonable cash position, the immense cost of late-stage clinical trials means that future capital raises are a near certainty. The expectation of a smooth funding process based on strong data could collide with the reality of a tightening capital market, potentially leading to dilutive financing rounds that could harm existing shareholders. This is a sector-wide pressure that is not unique to Incannex, but it is one that investors must factor into their risk assessment. The recent price action reflects this tug-of-war. The company's specific progress is pulling in one direction, while the broader market sentiment for speculative growth stocks is pulling in the other. Comment below with your thoughts. Do you believe the current market environment is the biggest headwind for developmental biotech stocks like Incannex? Or are company-specific risks more significant? Looking ahead, the future of Incannex stock will likely be determined by a few key catalysts and risks. The most significant near-term catalyst will be any communication regarding the company's interactions with the FDA and the design and timeline for the Phase 3 trial of IHL-42X. Positive guidance on this front could reignite investor confidence and send the stock on its next leg up. The expectation is a clear and efficient path forward. The reality could involve lengthy discussions with regulators and a more expensive or time-consuming trial design than currently anticipated. Another potential catalyst lies in the progress of their other pipeline candidates. Any positive data from their psychedelic medicine programs, for example, could broaden the company's appeal and diversify its risk profile. On the risk side, the primary concern remains clinical and regulatory execution. A setback in the IHL-42X program would be devastating for the stock, as so much of the current valuation is pinned on its success. Financing risk also remains paramount. The company will need to manage its cash burn carefully and secure additional funding on favorable terms to see its ambitious programs through to completion. The competitive landscape is also a factor. While IHL-42X appears to have a unique mechanism of action, other companies are also working on pharmacological solutions for OSA, and the emergence of a strong competitor could impact the drug's market potential. In conclusion, the story of Incannex Healthcare is a classic case of expectation versus reality in the biotech sector. The expectation is a simple, linear path, from positive clinical data to market disruption and shareholder wealth. The reality is a volatile, challenging, and non-linear journey where promising science is constantly tested by market sentiment, financial realities, and the rigorous demands of the regulatory process. The recent sell-off, despite the good news, is a stark reminder that progress in the lab does not always translate to immediate and sustained gains in the market. It reveals a sophisticated battlefield of profit-takers, long-term believers, and macroeconomic pressures. The company has a genuinely promising lead asset in a large and underserved market, but the path forward is laden with significant risk. The narrative has been written, but the most difficult chapters, late-stage trials, regulatory approval, and commercial launch are yet to be completed. The recent turbulence is not an invalidation of the company's potential, but rather a realistic pricing in of the immense challenges that still lie on the horizon, creating a complex and high-stakes scenario for investors.